All right, well, good afternoon, everyone, once again, and welcome to KoreConnect KoreSummit Webinar Series 2021. For some of us, it's already December 2021, but it's been, the last few weeks have felt for a long time. We're so grateful that all of you could make it today. These two webinars and today were really special because it's a very deep discussion points that most people kind of bury in the back, but we decided to bring it out in the open. So today we brought in a great panelists to have that great discussion. And as always, please, ladies first, take a moment to introduce yourself.
Hi, I'm Sarah Hanks. I'm CEO of CrowdCheck Inc. and managing partner of CrowdCheck Law. And together the two entities provide a wide range of legal diligence, disclosure, filing, and compliance services for issuers and intermediaries raising funds online.
Perfect.
I'm Joel Steinmetz. I'm the COO of Rialto Markets. We are a broker-dealer and an ATS, an alternative trading system that is recognized by the SEC and FINRA to be an alternative trading system. We operate specifically in private securities, Reg A, Reg D, Reg CF, in providing all broker-dealer services as well as all secondary market trading services on the ATS.
Wow, that was a great descriptor. Thank you. That was did you hear about the last webinar where I said you missed the layup?
Yes, you did. I did.
See, but I brought you back to the game. You're back in the game. Right. Perfect. All right. Well, today's discussion is kind of, I separated the two. I've seen people where they describe the two subject matters in one long document. Doesn't work. I figured that we would split this discussion on Section 12G, what the Rule 12G is. So, I'm not the lawyer. Joel's not the lawyer. Is there anybody here that's a lawyer? Oh, Sarah, you're it. You get to tell us.
You discovered my secret.
This is it. You're the one that everybody goes to. So this is an important rule because it does affect you all. It does have an effect on them, and people don't understand what it means and then how it applies. Please.
Exactly. I think part of the problem with the whole of 12G is people start in the wrong place. So if you start in the right place, it is with the statute, and it's a section in the Securities Exchange Act of 1934, Section 12G, which basically says if an issuer has with respect to a specific class of equity securities, it has more than 2,000 shareholders, no more than 500 of whom can be non-accredited, and it has $10 million in assets, that's just assets, not net assets, then it must register that class of securities with the SEC and become a reporting company with respect to that class of securities. And that's always the starting point for any of these. There are exemptions under Reg CF. There's an exemption under Reg A. Wonderfully, they are just different exemptions. But there's a conditional exemption under Regulation A that says if you trigger those things, so you've got $10 million in assets and you've sold a class of securities, equity securities, to more than 500 people, do you have to register with the SEC? No, provided that you are compliant with your ongoing requirements under Regulation A. Your public float, that is the amount of securities traded in your main securities trading place, if you have one, held by non-affiliates, is $75 million or less. Or if you don't have a public float, your annual revenues are less than 50 million. And third condition, you must use a registered transfer agent. If you meet all three of those things, you are allowed not to count the Reg A investors as being holders of securities, shareholders of securities, for the purposes of calculations of Section 12G. And I go through this all the time because people get sort of the steps all confused. But then the regulation CF is different because it's the conditional exemption there is you don't count the Reg CF securities, not just the Reg CF securities in the hands of the people who bought under Reg CF, but also the people they sell to. So you've got to keep track of them, but you don't count them so long as you meet the conditional exemption for Reg CF, which is conditional upon not having more than $25 million in assets. So it takes the $10 million asset test and puts it somewhere else. So yeah, they're completely confusing. And the way all of us would have loved for this to have started out would be for the SEC to say, don't need to count crowdfunding. You don't need to count the crowd. But no, it's more complicated than that.
Okay. So let's make sure I got it, because my head is twisting in circles. I don't know about yours, Joel, but I always knew it was over 2,000, but I didn't coin for the other elements of it. But so for every regulation, there's a different way of approaching it, right? Well,
for the two regulations where there are exemptions, where there are conditional exemptions. But for Reg D, the other one we deal with all the time, there's no conditional exemption for that.
And that's the one. Okay, so in Reg D, there is no conditional. So once you hit 2,000, you become a reporting issuer with the SEC. If
you count those holders of record. Remember, it's 2,000, no more than 500 of him can be, non-accredited. Now, so in Reg D, where you're selling only to accredited investors, you need to keep that number below 2,000. But that we can get into all of the special purpose vehicles and how they can be used across the exemption.
Yeah, obviously, but that's been predominantly the issue, because then, coming to you, Yul, I mean, okay, let's just talk about Reg D for a bit, and we'll go into the other two regulations really quickly. Let's talk about Reg D, because that's been where most of the capital is sitting today in companies, right? You're the secondary market trading. You're obviously going to take care of Blue Sky. Blue Sky still applies here, right, Sarah?
For trading, yep. Okay. Same things that we talked about on the other webinar, yep.
Okay, so we got Blue Sky that needs to be followed, but now you got to add another hook to this, 12G. From a secondary market, how do you see that panning out?
So from a Reg D perspective, from our platform, in a lot of ways, it's a little bit easier. Firstly, as Sarah explained, it's less complex, simply because there's no conditional exemption involved. But second, the Reg Ds seem to attract a larger investor. So making sure you stay below 2,000 in a lot of ways is easier. Reg D is not really going out to many of the retail investors. Once you get to Reg A and Reg CF, where you're getting into real crowdfunding, that's when those complexities and complications come into play. So in one sense, the Reg D, even though it doesn't have those additional exemptions, it becomes easier just because the manner of which it's invested. And that's really what we're seeing, I think, on the Reg D.
Okay, so I'm going to throw a twist at you, because I'm reading, accredited investor, we are going to fractionalize the investment. So when I hear the word fractionalization and on the Reg D, because you're right, traditionally it's been institutional big players, and now we want to bring it to all the accredited, but you really can't, because you've got to keep it under 2,000. So there isn't too much fractionalization happening with that. I mean, I just want to make sure people understand that, because they think that when I go fractionalization, it's only the first holder. Somebody described it to me this way. Oh, Oscar, that's okay. As long as the first holders are 2,000, the fractionalization, they're under that individual.
Well, that might count. That might work in some cases, but it gets super complicated.
Yeah, the fractionalization aspect of it is supposed to enable just a lot of other people to get involved, but the very nature of Reg D's almost requiring you to be an accredited investor lends itself to say, I'm going to people who are going to invest more. And if it's going to invest more, then you're going to have less investors because the entire undertaking is going to be taken up by a lot less people who are investing more. And still, even within the fractionalization world, Reg D can still be fractionalized. But, if I have the Mona Lisa that's fractionalized and it's for accredited investors as a Reg D, you'll get people investing $100,000 or $50,000. That's an accredited investor. It won't be that many of them to get to whatever, million or $10 million painting I have that I'm fractionalizing. Whereas if it's a Reg A and I'm going into the $1,000, a $500 investment, now I'm getting into a completely different universe that is by nature probably going to go above the 2,000. And that's when you start getting into, can I get to some of the conditional exemptions? So I think actually, just to go back, with one thing that Sarah was talking about is that the complexities that exist and the starting point is very important. And Sarah laid out the starting point, and that is a crucial starting point. Where do you start from? The second idea is, what kind of security are you starting from? Are you dealing with a Reg D, a Reg A, or a Reg CF? Because forget the legal stuff right now. Okay. That's going to determine the business approach that you have. And if it's a Reg D or a Reg A or Reg CF, it's going to have a different business approach. It's going to attract a different clientele. And if that's the case, then you have to concern yourselves with some of the rules, regulations, and exemptions that exist in the different entities.
Okay. And that's fair. And that is true. Depending on the regulation, that's why I picked Reg D. And the only reason I'm doing that is because the 12G discussion really comes up in the Reg D world. And it comes up a lot, right? So I'm reading an article right now that's saying that the way to bypass 12G is to file it with a Reg S. So
Oscar, just so you know, when we get those questions, we send them right to Sarah.
Well, I know we're all do, but look,
it doesn't make any sense.
I know, in all fairness to people, they keep on, oh, listen, guy, and I'm reading this because people are trying to find ways to sell to more accredited, and but the bottom line is this: that if the starting point is regulation D, right, whether it's 506B or C, the rule is 2,000. That's it. After that, you become a reporting entity with the SEC and everything else that entails. If your starting point now becomes Reg CF, that's your starting point. That is the starting point you're coming at. So here's what I'm going to throw. If, let's say I did do a Reg D and then I had a Reg CF, how does one precede the other, or are these two secured, even though they're both sold as common shares, but I sold them at different times? How does that work in this window?
Well, the starting point is always going to be counting. You start with counting. And so what do you count? If you sold them under Reg D, you count those holders. And we can get into what the definition of holders of record is and that the tiering that you mentioned, but start with the holders. How many holders? For Reg D, you count them. If they are on your books, they count. With respect to the Reg A or CF, the question is, do you count them or not? And you don't count them if they fall into the conditional exemptions, if the company is not compliant with the conditional exemption. Or let's take a really bizarre example. The company raised under Reg D, then it raised under CF, and then it raised under A. Actually, it's not so bizarre. And for whatever reason, it forgot to file its Form CARs. It did the CF, got 2,000 investors, 1,500 investors in the CF, and then it did a Reg A, and it's compliant with the Reg A. So what do you count? You count the Ds, all of them. You now have to count the CFs because, oops, you are not in compliance with the conditional exemption. And then you look at the As and you're like, oh, I'm in compliance with that. I don't count them.
Okay, so what an eye-opener for me today that was. See, look at me. I'm like a kid in a candy store right now, Joe. Sorry, because you and I are going to be encountering this. We have a number of issuers where they have Ds and they have CFs and they have As. So if I just got you correctly, the only way you get to utilize that exemption for C or C is that you also have to file your AR, which is the annual. Is that what you're referring to?
That's right. That's the annual. It's the baby equivalent of the 1K, and any company that's done these filings, that's done these raises, has ongoing reporting requirements, which may or may not be ended. So for example, let's say that this company did the D and sold to a certain number in the D, then it did the A, and it sold to 299 shareholders under the CF. And then it did the A and it sold to 501 shareholders under the A. So what do we got? The CF, the analysis that you have to do with respect to do we count the CF holders or not, is are you compliant with the CF requirements? CF requirements, you're going to look and you go, okay, there's a form. Here's a form CAR for 2018. Here's one for 2019. Then there's this CTR thing, don't know what that is, but they didn't file for 2020. What's going on? Well, it could have been that they had, because they only had that 299 shareholders, which is less than 300, you can exit the Reg CF reporting requirement if you have fewer than 300 shareholders. So that's another thing that you have to do. You still, because they're still compliant, right? Still compliant, that they have not, if they still haven't got total assets in excess of 25 million, still compliant, you still don't count them. It just becomes very, very complicated. You need, a law degree and a math degree to do that stuff.
Well, I'm lucky because I brought Joel, and from what I understand, he's got a PhD as well on ATS. So 9 under his belt. See, I haven't forgotten that, 9. Okay, Joel, so on my bat, I mean, how does this thing work then on a second? Like, I got all this bunch, so I'm breaking them apart. You need to break each of these securities and be able to make sure that they're fully compliant in each way. Like, there's no way to intercombine them, right, Sarah?
Yeah, so yeah, I'm just going to go down the path of the way we sort of look at it.
Yeah.
And again, it's going back to Sarah's original statement, because this is really important. You have to know where your starting point is, right? The starting point is the rule. The rule, let's just call it the 2000 rule, right? It's the rule of having 2,000 investors, like staying under 2,000. That's number one. Number one is that's my number. Then once I get to that number, I then have to figure out, what am I doing? A Reg A, Reg CF, Reg D. Depending on which one I have, I then say, how do I count to the 2,000? Then I go to a respective exemption. If it's Reg D, there is no exemption. If it's Reg A, it's exemption 1. If it's Reg CF, it's exemption 2. And that's how I get to my number of 2,500, aside from the 300 that Sarah was talking about, the 2,500. That's how I get to that number. So I start off saying, I know the rule. Then I go and say, what's the security I'm doing? And then I go and say, is there an exemption, so I can determine how many I deal with? What's important is that each one of them can be looked at in a silo. So when I've done my Reg A, I look at it in a silo and say, do I have the exemption in order not to count these for my Reg A? I do the same thing for my Reg CF. And then I can determine whether I have to, for the Reg CF, I have to count these people. For the Reg A, maybe I don't have to count them. Did I get the exemption here? Did I not get the exemption there? But it has to be done step by step. I think that's the key component for any issuer, is to look at it step by step and not try to get too complicated by putting them all together, just one step at a time.
Obviously, yeah, that'll be pretty tough for some, the way people look at things, right? They see the whole list, and but not only step by step splitting them, but also making sure that each of those securities, each independent security, has been properly filed with the SEC to meet the requirement to list or to be able to be usable, the exemption. I got that correct, right, Sarah?
Yeah, I'm going to sort of like rephrase it. With respect to each exemption, make sure that the filings have been made by the issuer with respect to that exemption in order to be able to rely on that specific conditional exemption.
Okay,
that specific type of offering.
Why is this so? Then, obviously, you go out there everywhere. There's a lot of conversation on it, confusion on it. I mean, we run into companies where oddly enough, they think they know the regulation, but they get their formula confusing. Why has this become so confusing? Because it didn't get wrapped up. It's crowdfunding. It should all be there. Or is it because if you have 10 million in assets, if you've got X number of holders, it's all these different conditions. Like you said, you need a mathematics, a PhD, and a psychological and a legal degree. Is that the way it works?
The problem is that I mean this was one of the issues that the SEC raised in 2019 when they put out their concept release, and they said, look, we understand all of these exemptions. They're super complicated. You've got registration over here, and that's complicated enough. But then you've got the exemptions. You've got 3 different flavors of D. You've got S. You've got CF. You've got A, and all of them have restrictions on who can invest. All of them have restrictions on how much can be raised. All of them have issues with respect to whether they're restricted, non-restricted. And let's try and make it all easier. And all of us commenting on the concept release said, yes, absolutely. Complete rewrite, start from the beginning. This stuff has been around for, how many years, and since 1933, and it's just sort of, it's got so many barnacles on it. There's so many rules on top of rules on top. Let's just start from the beginning. And my preference would have been, throw out the regulation of offers and just regulate sales. And there was a lot of suggestions made. Unfortunately, when the SEC came to do the revisions that went into effect last week, they just did the simple stuff. They said, look, there's enough people who kind of think that this is all okay, all of whom are securities lawyers, by the way. The American Bar Association's mostly, yes, fine. Yeah, we're making plenty of money, just interpreting these things. And so they did they attacked the low-hanging fruit. So some things have been coordinated and smoothed out. Investor limits in Reg A and Reg CF are a lot closer than they were, which is good. But there's still a lot of different reasons for different offerings, which are not necessarily obvious to the external observer. And you can't do any of this stuff without a securities lawyer.
Yeah, that's it, and that's clearly one thing that we will always stress, no matter how much easier we're making it, that isn't removing the intermediary that's really essential to providing the guidance and understanding of the regulations. So, from a secondary point of view, though, pushing it all off to Sarah, it sounds like a good idea. I mean, you're not the only one. We do it too. But at the same time, I almost feel like, look, earlier this morning, Sarah, we were talking about blue sky. Why is blue sky? Because everybody's now talking about secondary market trading. And then now we've got trading. So you got to think about the primary as you're bringing in investors to make sure you've done it fully compliant. And then obviously we got this off-ramp venue, which is Rialto Markets, a secondary market, a platform to be able to allow me to take my security, only to find out that I may not be able to do so, because if everything hasn't been done accordingly, how do you, as a secondary market, I mean, for Blue Sky, I know how you're covered. How does a secondary market cover itself to ensure the other elements are also being met to make sure that trading can be done in fully compliant of Rule 12G, right?
Yeah, so in essence, firstly, it's making sure you have all the parties that need to be involved. And from our perspective, there are two major parties that have to be there. As Sarah said, it's very important to get a securities lawyer involved. I would add to that and say it's very important to get a securities lawyer who's actually knowledgeable within what you're doing, Reg A, Reg CF, Reg D. A securities lawyer that's not as knowledgeable in these particular rules and regulations is not going to really do you justice. You need to make sure they're really experts in this particular area. The second thing is also working with the transfer agents, who are the ultimate arbiters of ownership, and making sure that the transfer agents are aware and inclusive of the numbers and the counting, right? We're all talking about the counting here. That's the first component. It's really just working with the issuer to make sure that the external, when I say external, I mean external to the ATS, the external parties are also included, like the lawyers, like the transfer agents as examples. And if those are included, then at least from the beginnings perspective, starting point, the issuer is going to go down the path that we expect them and need them to go down. The second component of it is, can you build this into the issue itself so that the system recognizes the issue and all its component parts? So with digital securities, for example, it's possible to build into the issue itself these restrictions and limitations so that when a new buyer comes into the system to try to purchase that particular security, the rules and limitations and filters are part and parcel of the security. And in that way, it will reject the order, or it'll inform what has to be done. It'll check if it has to check, but it'll go through the steps in order to make sure that compliance that was written into the security is adhered to. And those are really the two elements that the ATS will come, and the broker dealer actually will put into play in order to assure that these rules are complied with.
Yeah, when you have regulated parties, I agree. I think enough regulated parties in the room, part of the transaction, you will clearly know, everybody's asking all the right questions. It's compliant. Have you made your filing requirements? Have you filed this? Have you filed that? So everything's to be, but the reality is that we know that that's not always the case, right? And that is not always the case. And when you see someone's cap table, and we see a lot of cap tables, and what the reason why I'm asking this question very strangely to all of you is because what you're saying and what we're seeing don't always match up. Mm-hmm. And I'm, last night at 11 o'clock at night, I'm getting a call because everybody's hustling right now to reconcile their stuff. And I'm scratching my head, like on one hand here, because that's 3,000. And I'm going to, and like you, I separated in buckets. I didn't even know I had to, but I did it just for my sake. And the numbers just weren't adding up. See, even Maximus doesn't think they're adding up. Even he agrees with me. So what is happening to where's the safety net? Because the problem with Reg D, as we all know, the company doesn't need a transfer agent. At least I could be wrong, right? Sarah, am I wrong on
that's
that?
right. You don't have to have a transfer agent, and you don't technically have to have a transfer agent for A or CF either. It's just that if you don't, you are not going to ever get that conditional exemption. So the moment you go above, 500 non-accredited investors, oops, you're required to register. But Reg D does not require any kind of transfer agent, and we do see this a lot.
So then we're relying on the issuer itself to self-regulate itself somehow to make judgment calls on that 2,000, right?
Yeah, well, you're relying on the issuer to know that there's an issue, to know that if they go above, that number of holders, that they're going to be in trouble. And as Joel says, I mean, a lot of when you're dealing with a lot of accredited investors, and especially when you're dealing with tech startups and the like, there is. The VCs don't want to have a lot of people on the cap table anyway. They want big checks. They don't want to have a lot of little checks. So there's sort of self-regulator there. And then we can also get into the use of SPVs in Reg D, because that's an important part of this whole thing. But yes, you are relying on the issuer, frequently a startup, to know that there is an issue here that they have to keep an eye on, and to actually keep an eye on it. And we know that's
I just bring it up. I was just curious because in Reg CF and Reg A, you're right. I mean, people don't think twice about it. They automatically get a transfer agent. It brings clarity, but I mean, there are issues, but it's not for this discussion. But you brought up an interesting point to take the discussion to the next stage. SPV. Here's a vehicle that we're now talking about a lot because of Reg CF. You hear it a lot in Reg D. I'm going to come back to you, Joel. How do you trade that? So the SPV vehicle, you mentioned that as a vehicle that, okay, well, how is it that in that vehicle I can put more than I do in the entity? What makes it special to be able to do that?
Well, from the point of view of Reg D, now let's assume, which is not always a correct assumption, assume that the SPV has not been created purely to avoid the requirements of Regulation 12G. Because if you did that, for example, do we remember Google way back when, like 15 years ago? It was Goldman Sachs took a whole bunch of people, stuck them into an SPV purely so that they wouldn't trigger the number, which was different back in those days, but purely so that they wouldn't go over the wrong number, and require registration before the company was ready. So you can't just bundle them up and say, here, we just want to stick them in an SPV, because the thing is, if you have an entity like an SPV, not created for the purpose of avoidance of the securities laws, that's going to count as one holder. And many cases, these investments are, people get together, they get a gang together in order to invest. They're assigning, they're basically they're little VC funds, right? There's somebody out there who's the lead investor, there's somebody out there with a carry, and they've got some kind of 2 and 20 structure, and they're charging wealthy investors a fortune for the privilege of being invested. But providing that wasn't created just to avoid the securities laws, that counts as one, which of course means that if anybody wants to be trading later and they come to y'all, you're going to have to suck all of those securities out before they could ever be traded.
But how? Oh, okay, so all right. So the SPV, I get it. It becomes one holder in the entity, but the SPV still has the same rule of thumb. It cannot exceed 2,000. So the idea is to put
even more complicated, because if it were to have more than 2,000, then it would have a problem. But it's going to run into its own problems if it has more than 100 holders. If it's a fund, because it is going to be a fund, right? So it's subject to all of the fund exemptions, which say no more than 100 holders, or 250 if you fall into this very special bucket of funds.
Okay.
Is it complicated enough yet?
Well, look, everybody makes it sound like, oh, Oscar, we're going to be looking at an SPV. I'm going, my God, I'm still trying to figure out how to run this company. Now I'm going to add another one. Yeah. I mean, that's the way I look at it, right? This is complicated enough. This is not going to give me a pass on that. It just now gave me another thing that I need to manage to make sure that it's there. From a secondary market point of view, I mean, I mean, you've seen all of it, all this stuff happen before in the market. Have you seen holders inside SPV to be able to, can an SPV trade? First of all,
it can, but to Sarah's point, a lot of times when it wants to trade, you have to then reach in and pull out the securities and have those come into the investments. So, you know, it sort of gets back to the previous discussion. That, you know, in a regulated environment, that's the way we want to operate. We want to operate in a regulated environment where everyone's considering the regulations. The problem is, it's not people doing things illegally out of being evil. It's lack of education. And that's really the challenge. The challenge is just making sure that this example is a great example. People just say, you know what, I'm going to create an SPV. And they don't necessarily recognize the repercussions and consequences of creating the SPV. It doesn't solve all your problems. And a great example is the one Sarah just, I think, happened to come by. And that is when you hit 100. So people start thinking, well, I've gotten rid of the problem that I was trying to deal with in the SPV, and now I have 200 investors in my SPV. This is great. And you don't realize that you just created a whole new problem for yourself, right? And that's the education that needs to be incorporated. And it is very complex. We don't expect the regulators to make it necessarily easy or non-complex, but recognize that when you're doing one thing to solve problem A, you better be knowledgeable enough not to run into problem B while doing that.
Yeah.
No, that's a great point, Joe. And the only reason I bring it up is because, you know, when you talk about people with, oh yeah, that's easy workaround, I'll just get an SPV. That's the throwback, right? So This is a great point for them to hear that the SPV has its own limitations. And 100, I mean, Jesus, there's not a lot of trading there.
Right. And in that way, because of it, it's not really going to solve your problem. Probably not, unless you're at 2050, right? But if you're already getting to a point where you're way above 2000 and now you're at 4000 and you say, well, let me get rid of these and put them into an SPV so I get under 2000, it's just not going to work, right? It's only when you're just a little bit above it. And like Sarah said, you have to make sure that you're not doing it just to avoid the law. But it has its own hair that you better be ready to deal with.
Yeah, I'm thinking all the different questions that I've got. That's why I'm putting them towards both of you, because these are now these 2 points are fully together now. Before it wasn't such a big deal. I think everybody knew about the 12G issue. So now it comes to hard question I'm going to ask Sarah. So what happens when a company is over and nobody knows?
Well, if nobody knows, that's great. But if the SEC knows, then not so great. Because you know, the next step is, you know, the company has violated at some stage the requirements of Section 12G, that, you know, when you reach these limits, that you get registered with the SEC. And so the obvious solution would be go register with the SEC. That the next follow-up would be, well, why hadn't the company already done this? Possibly because it's an early stage company that really couldn't cope with the whole being public thing. But if you don't, you violated the law. So what, you know, I always say the SEC doesn't have handcuffs. They just sue people. And they can try and force you to get registered. If they thought you did it criminally, they can hand it over to the Department of Justice. But they are the ones with the power in that stage. And when you have where it's really going to come up is when the company is in fact ready. So let's say, you know, nobody notices. They've just done this. Nobody's keeping good records. They've got, you know, the cap table on the back of an envelope. Everything's chaotic. They come to do their IPO. They want to register on an S1. They give the whole history of the company. And the SEC and the investment, but well, probably the investment bankers before that, look at the whole history and go, do you think you should have registered earlier? How do we fix this? And you're going to have a whale of a time with the SEC trying to work it all out.
Yeah, I would say the company we run into, I don't think they're doing it on purpose. I think most of them just don't know, or they're too afraid to ask because they think, they've read enough, or they do the math and they go, well, these counted as employees and this, that, and somehow they make the math look proper, or they're hoping that the minute they file for a Reg CF and Reg A, it goes away. Does it ever go away if they do that?
No, it's not going to make it better. Could make it worse, but it's certainly not going to make it better. You're just acquiring more shareholders is not going to solve the problem of having too many shareholders.
No. And okay, so that's a good lesson. I mean, look, we talked right from the beginning. We said you started it properly, what direction you're going to take on your strategy and your raise, and it's gonna be helping you as to what you need to follow. And Joel, from you guys at Rialto, really, it sounds to me like when it comes to this particular rule, you are relying heavily on the legal aspect of it. Is there legal opinions required, in particular with accredited investors, if a company only has that, in order for you to have the assurance that there's only, let's say, 1,000 shareholders and you have room? I mean, is that part of one of the requirements that you're looking at?
We're not. We have not run into anyone who's really sort of asked for specific legal opinions in order to be able to get involved in any of the investments in these securities. I think people are relying on others. We definitely rely very heavily, particularly in this aspect, on legal teams, attorneys and their opinions. And we suggest, it's our first suggestion every time, is make sure you get yourself, as Sarah said, good securities. We say a good Reg A or Reg D or Reg CF lawyer. You need someone really good to be able to do that. And it's very important to go down that path to make sure the issuer is comfortable. We don't have to go back far. It's particularly over the last couple of years that the SEC has been looking a little more carefully to make sure that issuers are complying. And it is investor protection. They are doing this for the benefit of the markets. And we should recognize that they are doing this for the benefit of the markets. As such, there are loads of people out there to help, whether it's broker-dealers like Rialto, or attorneys like Sarah, or transfer agents like KoreSummit. It doesn't matter who you go to. Someone needs to help you, and you need to make sure that you have that in order to assure you're going down the right path. Once down that path, your approach to the investor community now has a different look and feel. You don't have to necessarily say, here's my opinion later. You can just say, yes, we have attorneys that have worked on it. These are the attorneys. And with Reg A, it's publicly filed. They can say, these are the attorneys, this is the broker-dealer, this is the transfer agent. It's covered. And that is generally sufficient.
Yeah, it's I do agree with you now. It's become, look, this morning we discussed Blue Sky, right? And the difference between Blue Sky and 12G, to me, there's no gray. This is purely black and white, right? It's a black and white, or is there gray? And she's smiling because she's going to give me
I think there's some gray in the creation of SPVs in Reg D, and I think there always has been. It's all been a little squirrely. The rest of it, no, it's kind of, And when you're dealing with numbers, the numbers are the numbers.
The numbers are the numbers. And if you're going to play with the SPV, you better hope you got a good fund administrator who knows what the heck they're doing. And they would. I mean, the bottom line is that whenever you think you're going to find another way around it, you're going to come right back to the same problem, as Joel kept saying. It doesn't make the numbers go away. And that's probably I think that's the rule. And you also said something earlier today as well, that this year we're going to see more enforcement. And you just said it, Joel. Because the regulators have increased the limits. So they're going to, they've increased the limits to Reg CF and Reg A. So I'll throw something at you. Will that mean they will be enforcing more of the Reg A deals who have not met their CR or their CAR, their annual report?
That's the Reg CF ones. They say they will.
Okay.
I mean, in one of the comments that we made in the proposals were with respect to putting up the limit is, okay, if you want to put the limit up, you should enforce the rules that you have because nobody is complying with them. I mean, this is a cesspool of non-compliance. And so the SEC really needs to start looking at both initial disclosure compliance and ongoing reporting compliance. And I think we'll see more focus on the CF offerings than on the A's, because the A's have the investor protection. There is the SEC reviews them. There is a legal opinion in there. There is audited financials that we know are audited financials, and there's an auditor's consent. I mean, there's a whole bunch of investor protection in A that does not exist in C, because in C you just file it and then nothing happens. So I think the SEC is going to start looking at those, and I would expect there to be more enforcement on the CF side than the A.
Yeah,
sorry, just to jump in from again the perspective, let's say, of the broker dealer, when people are asking, just trying to find out what's the best avenue to take, should they go for Reg CF or Reg A? Generally, the thought process is just on money. Well, how much are you raising? But in reality, there are a bunch of other things that have to be considered, including the amount of investors you're going to have, what might be the exemptions that you can come across, what's the time period it's going to take, what financials you have to deliver. All of those become component parts of the decision-making of which avenue you want to take. Once again, it just comes back to an education process. We should really be very proud of ourselves as an industry for getting this Jobs Act and all the things that are in there as far as we have, but not fool ourselves into thinking that this has been going on for everyone ever and everyone should know about it. A lot of these things are coming up new. Look, today we had more stuff coming in new. There are always new things that are coming in. People are still getting up to speed on the education of what this means and what the exemptions are and what the rules are. And it's just an education process till people figure it out.
Yeah, I do agree with you. I think we're still in the early stages of the education, but at least we're having the honest discussion with people that you've got to split the regulations. You got to look at, I made the mistake, maybe even me in the early days, I was combining it all together, right? I will be the first to tell you, I remember once saying, and I did apologize to everyone, and was that I made the assumption that, since you have Reg D investors and you did a Reg A, it all gets under the wrapper. But, Sarah set me straight. She took me to, she said, don't ever do that again,
Yeah.
It is it's an evolution that this education needs to continue to make sure people do it right. And even when you do get the exemption, as we have it in Reg CF and Reg A, the Reg CF is the one that probably concerns Sarah the most. I know that she's been very vocal about it, and I in fact, not only is she vocal, I concur it because I see it. Yeah. So her and I, we share the commonality, and I don't think the reason I brought this up is because I've been going to the issuers that are failing to do it, and they go, what's the worst thing that can happen to me? And said, well, your violation of Rule 12G. Goes, what's that? I did a Reg CF round. That doesn't apply to me. And I'm going, wow, this is this is where we need to, and if this year is going to be the year of enforcement, the SEC likes making good example of people in order for people to learn. There's nothing wrong with that, right? So I think it's a good discussion. And obviously the reason Viola brought secondary is because people want to lead it to there. Do you know what I mean? These discussions never came up before, but it halts all your activities for off-ramp for your investors to monetize. it puts a dead halt on everything, because you go in and say, hey, I can't touch this, right? You got to go back and do something about this before I can. So it can have a material effect all the way around for everyone, to make sure that, each security you sell. So let me ask each of you a closing. I mean, 12G is an old rule. I read it somewhere. It's one of the oldest rules. It's boring. Nobody likes talking about it. And only us, we're going to make it like a circus. We're going to make it fun. But what would be your last comments to this discussion? What would be some advice you would give people, Joel, on your end, when considering everything? I know you said it before, some items, but what would be your closing remarks on this?
Well, from my perspective, from our perspective, I should say, from our perspective, yes, the fact that there is a secondary market now in these securities, aside from a primary one, makes it a real marketplace. And that's really what we want for these securities. We want it to be a real marketplace with not only the on-ramp that allows you to get involved in the securities and invest in them, but an off-ramp in order to be able to monetize. And that is an essential element. The three things that I'd say are really most important are, number one, make sure you get a good lawyer. Make sure you have a lawyer that really understands this. Number two, get educated on any one of the offerings, whether you're doing 1, 2, or 3 of them, doesn't matter. Make sure you are fully educated on what that means and all its nuances, complexities, and repercussions. And number three would be to just assure that when you're getting involved in this, whatever it is that you're doing, that you've incorporated the entire community to help you do it. You need to be educated in what's going on, but then you're going to need help, and recognize that help is going to come in the primary markets and in secondary markets. And there are plenty of people out there who can perform whatever functions you need to help you get through this whole idea. And if we do that right, we will actually have a very robust marketplace in the primary and secondary markets for private securities, ones that will not only meet, but probably surpass what we have in public securities, as long as we've assured that we're doing it the right way.
That's good. I like that. Sarah, to you.
All right. So there was one thing I wanted to raise that we hadn't actually really touched on, which is the use of SBVs in Reg CF, which is new from last Monday.
Yes.
Which is if you meet the requirements of a regulation CF SPV, then you are able to have all of your regulation CF shareholders go through that SPV, and it will count as one holder of record for regulation for Section 12G. It does become more complicated, though, to look back to one of the things that Joel had said, trading, because the things that the investors hold are going to be interests in the SPV, not in the underlying company. And so if you ever want trading in the company securities as opposed to the SPV securities, which you could trade, I guess, you're going to have to go into the SPV and disassemble it, at which point all of the shareholders are going to count individually again. And the conditions for use of the SPV are that it can't be, a profit-making center in its own. There is no carry here. Administrative fees can be accepted by the issuer, not by the investor. They can't be passed on. And the way that we've structured these things is that to comply with the requirements, the economic and voting rights that are in the shares that the company is selling under CF have to be absolutely passed through. You can't change them, charge fees, change the voting terms of the underlying securities at all. And when you come to do the registration, the filing with the SEC, both the SPV and the issuer file, both the SPV and the issuer need to have financial statements. If you're looking to raise $5 million, that is audited financials for both of them. And it's a very restrictive thing. But you don't. It only counts as one. Now, when you have the messy cap table discussion with VCs, there's no longer a messy cap table for the company, but there's a messy cap table for the special purpose vehicle.
But the company still has to manage the SPV, though.
So somebody has to. I mean, there are going to be services out there, but the way we've set it up is as a manager managed LLC in order to sort of pass through as accurately as possible. But anyway, so just throwing that in there right at the end to say, hey, here's another complication. But that's one of the things that we've kind of noticed in the whole SPV thing since last week is I think people have not realized that you've got two issuers there. They're co-issuers. Both need to file.
Yeah, and that was the point, Sarah, that a lot of people didn't realize. They think the SPV is not an entity. And that's the part that, because they hear the word special purpose vehicle. Well, what kind of vehicle do you think it is? A Maserati? No, but seriously, I have to remind them, it's a legal entity. What do you mean? It's a legal entity. You'll have to incorporate it. You have to create a structure. You'll have to have. So I think it's for those who have done it before, like in real estate, where it's common in VCs and funds, that's new to them. This is a brand new audience that they're still trying to figure out what a warrant is, right? What options are. Now we brought in this other instrument. Can I ask you just last question on this one, because you brought up the SPV component to it. So the investor invests in company ABC. ABC is the one that's all over there. And that's the company that's drawing me in. That's the company that's telling me all about keep in mind that this is not the accredited investors. This is the general public. And all of a sudden you make the investment and everything there is still John Doe, but now you find out later, it's never at the time of investment, that you are in this SPV. And you actually have no ownership in that company at all directly. I know that's room for another discussion. I brought it up only because it's already starting to happen. And I've often wondered if the SPVs are only meant for one audience only. And you have to be fully versed in it.
Yeah, if you're going to do an SPV, you're going to need to do proper explaining. Is like, when I go onto my my dashboard on funding portal XYZ, why does it show SPV for the widget company? Why is it not just the widget company? And how do I sell my shares in the widget company? And the answer is, you're probably not going to be able to do that.
Yeah, I'm already dealing with a scenario already where the investor already invested previously, now invested the second time, and the second time they even showed us the picture of the video, and the name of the legal entity they was put under was in fine print. Mm-hmm. And they said, I watched the video, I invested in Yol, I'm just picking on you. I know you, but I bring it up. I know that's another discussion. Obviously, these are all these discussions are meant to stir discussion, to make you hopefully provide you enough guidance and understanding that these are not things you just spit out and say, oh, I know how to deal with Rule 12G or Blue Sky. The idea is you need professionals. That's what, every one of our sessions is meant to do that. And if you want to get a hold of Sarah and learn more about how to do things the right way, whether you're doing a Reg D, Reg A, or Reg CF, her contact details are at KoreSummit.io as well. You can find Yol, the leading, obviously, secondary market, who is allowing those who have securities in both Reg D, Reg CF, and Reg A to allow you a off-ramp for your investors to monetize their investment in a registered secondary market. So thank you again, both of you, for a wonderful discussion today for a subject matter that often is very difficult. We made it fun, I hope. As always, it's good to see you both, and thank you everyone else as
Thanks,
well
Oscar.
for all of us. Take care,
Have a
everyone.
good night. Thank you.